If you're saving for a home deposit, the First Home Super Saver scheme could give your savings a real boost, not just through tax savings, but also potentially better returns than a regular savings account. It lets you make voluntary contributions to your super and withdraw them later to put towards your first home. In this video, Kate Crawford explains how it works, the benefits and the limits, and the key rules to follow so you don't get caught out when it's time to access your savings. Please remember this information is general in nature and doesn't take into account your own situation. If you find this guide useful, please remember to subscribe so you don't miss out when we publish a new video.
The First Home Super Saver scheme allows you to contribute up to $15,000 per year and $50,000 in total to your super account that you'll later withdraw to use towards the purchase of your first home. You can't have owned property before, including investment property and vacant land. But if you have owned property that you've since lost due to financial hardship, you can apply to the Australian Tax Office for an exemption that will allow you to use the First Home Super Saver scheme. If that's you, you should apply for that exemption before you start making any super contributions, in case the ATO is not able to approve it. Only personal voluntary contributions that you've made to super since the 1st of July 2017 are available to be withdrawn. That includes both after-tax or non-concessional contributions, as well as pre-tax, tax-deductible concessional contributions. In this video, we'll focus on concessional contributions, but if you're a lower income earner, non-concessional contributions can also have benefits, including access to a co-contribution from the government. So it is important to take your own personal circumstances into account. Unlike many other first home buyer schemes, your eligibility for the First Home Super Saver is assessed on an individual basis, not per property. So if you're buying with a partner and only one of you is a first home buyer, that person would be eligible to use the scheme, whereas the non-first home buyer would not be. The same goes for groups of friends buying together or relatives. Any person who is a first home buyer could use the First Home Super Saver towards the purchase of that one property that people are buying together. The benefits of the scheme are tax saving and also a generous interest rate on your savings. And together, those combine to mean that many people can accumulate significantly more through the First Home Super Saver than they could by saving in a high interest account outside the super system. There is a catch. The scheme can only be used to purchase property that you're going to occupy as your first home. It can't be used for an investment property. Once you've purchased somewhere, you need to move in and live there for at least 6 of the first 12 months after it was first practical for you to move into the property. Let's talk processes and deadlines. You don't need to do anything while you're making your contributions. But when you're ready to withdraw, that's when you can log into MyGov and use the linked ATO service to process your request. The first step is to apply for a determination. That shows you how much you have available to withdraw, including your contributions and the earnings that have accrued. You can apply for as many determinations as you like, and every day additional earnings will accrue. But it's very important that you apply for your determination before the settlement date of any contract that you've signed to buy a property. If you miss that deadline, you won't be eligible to use the First Home Super Saver scheme. So your contributions will be stuck inside the super system until you meet another condition of release to withdraw that money, usually retiring after you've turned 60. The second step is to apply for your release. That can be done anytime up to 90 days after you sign a contract to buy a property, but you have to have a determination first. You can apply either before you've signed a contract or within that 90-day deadline. If you haven't already signed a contract to buy, you've got 24 months from the date of your release request to go ahead and do that. The usual deadline is 12 months, but the ATO will automatically extend it to 24 months if you miss that first deadline. If you haven't bought a property within that time, you need to recontribute the amount you withdrew to your super account or pay 20% additional tax on your withdrawal because you haven't used that money to purchase a home with. The last step is to notify the ATO that you've signed a contract to buy. And the deadline there is another 90 days after signing that contract. If you miss that deadline, you'll be liable for the 20% additional tax on your withdrawal. So do remember to go ahead and do that. Importantly, these deadlines were different for determinations that were issued before the 15th of September 2024. On those old determinations, you only had 14 days after signing a contract to apply for a release, and you needed to notify the ATO that you'd signed a contract within 28 days of signing that contract. It can take 3 to 4 weeks to receive your money after you apply for your release, so keep that in mind if you need that money to go towards your purchase price. This example can show us the potential benefit of the scheme. Here we have an individual earning $70,000 per year who can afford to save $850 a month towards their first home. If they go ahead and do that outside the super system, after a year, they will have contributed $10,200. If they instead chose to make salary sacrifice contributions to super, that same income earner would be able to contribute $1,250 a month. That's because salary sacrifice is coming out of their gross pay before income tax is calculated. If they go ahead and contribute that amount per month, their take-home pay will reduce by $850, which is the amount that they can afford. Those contributions to super will be taxed at 15% on the way into the fund. And after a year, the net amount remaining will have accumulated to $12,750 worth of contributions, leaving them just over $2,500 better off after a year because of the tax savings. On top of that, when they go ahead to make their withdrawal from the First Home Super Saver scheme, earnings will be added to those contributions. And the earning rate that is used is likely to be higher than what they would receive in a high interest saver outside super. That's because the shortfall interest charge rate is used, which is the same as the 90-day bank bill rate plus 3%. You can look up the shortfall interest charge on the ATO website anytime and see what the current rate is and how that compares with a savings account outside the super system. So the tax savings and that generous interest rate together combine to generate the benefit of the scheme. However, it is important to remember that the withdrawal from the First Home Super Saver will also be taxed. That will be taxed at marginal rates minus a 30% offset. So in this individual's case, they're in the 30% tax bracket. That means that including Medicare levy, their total tax rate is usually 32%. On their withdrawal, with a 30% offset, they'd be paying 2% tax on that amount. That is also important because it means that the earnings that have accrued are receiving that 30% tax rebate, whereas interest earned outside super would be taxed at their full marginal rate. So that can again add some additional benefit to using the First Home Super Saver scheme. If any non-concessional contributions are included in the withdrawal, those are returned to you tax-free because you've already paid income tax on that money before it was contributed to super. This calculator from the Commonwealth Super Corporation could help you estimate how the scheme could benefit you. When you get to this welcome page, just click Continue. It will show you the numbers that you last entered into the calculator. In my case, that's an income of $150,000 with $12,000 annual salary sacrifice. The tool will assume that you continue making those contributions until the maximum of $50,000 worth of savings towards the scheme has been reached. So if that's not what you're planning to do, unfortunately, it won't show you the exact benefit to you on this first screen. However, you can look at the results in a different way. So if you're not planning to save for the full 5 years to generate that nearly $14,000 benefit that's being shown, you can instead click to look at the chart that shows you year by year the difference between saving outside super and using First Home Super Saver. All calculators, of course, do have limitations, so make sure that you read the disclaimer and assumptions that are found at the bottom of the page. You can also go ahead and edit those assumptions if you would like to, so you can change all of these numbers to suit your personal circumstances and what you think will occur if you would like to. If we go back to the calculator, I can show you a different scenario. Say the person had annual income of $80,000 and could afford to salary sacrifice a smaller amount, say $8,000 per year. It will show the reduction in take-home pay so that you can see if that's going to be affordable for you. And it will change the savings duration, in this case, to 7 years so that you reach that maximum cap of $50,000 worth of contributions towards the scheme. The total annual contribution you can use towards First Home Super Saver is a maximum of $15,000 per year and $50,000 in total. However, if you're making concessional contributions, you're also limited by the annual concessional contribution cap. Your employer's contributions also count towards this cap. So if you don't have $15,000 worth of space between your employer's contributions and the cap for the year, you may not be able to use the full $15,000 worth of contributions towards First Home Super Saver. However, you can contribute more than the standard annual cap if you're eligible to carry forward previously unused concessional cap space from any one of the last 5 financial years. You're eligible for that measure if your total super balance on the last 30th of June was less than $500,000. So that could allow you to contribute more than the standard annual cap and make use of that full $15,000 allocation for the year. To learn more about carry forward, watch our separate video on that measure. You also don't need to contribute the full $15,000 each year or the total of $50,000 to benefit from the scheme. You can contribute whatever you can afford when you can. You might contribute for a few years and then take a few years off and contribute some more before finally making a withdrawal. If you have only just heard about the First Home Super Saver and you're almost ready to buy your home, you might think that you have missed out. But you could still make a personal tax-deductible contribution from your savings and then later withdraw that towards the purchase of your first home. As long as you haven't already signed a contract to buy, there is still that chance that you could get in at the last minute. SuperGuide members have access to a longer version of this video, including an example of using the scheme at the last minute and some traps to be aware of. You can sign up at superguide.com.au.